You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. Welcome back to This Week in Futures Options. You guys can't see it here, but that song always gets me. Certainly Nick. I can see Nick just dancing away over there. This thing. It's a very funky tune we have here for our intro. Welcome, of course, to This Week in Futures Options, the program on the old Options Insider Radio Network, where, as the name implies, we break down the hot activity across the broad spectrum of products that are lumped under that umbrella of futures options. Maybe it's rates, maybe it's soybeans, maybe it's gold, maybe it's crude, whatever's lighting it up this week. And it certainly has been an interesting week so far. And joining me to break down all of the activity we see lighting it up over there in the realm of futures options is my volatility and technology and indeed futures options compatriot / nemesis, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little analytics suite we like to call QuickStrike. Mr. Nick, welcome back to the show, sir.
What's up, Mark? Happy Friday. Looking forward to chatting once again.
You know, I don't know if you know this, but I like to pen nicknames for all of my co-hosts here on the network, and I still haven't come up with one that encapsulates you. I'm working on it, so I'll let you know when I have some offerings pretty soon. But nothing's leaping to mind for you right now for Nick. But don't worry, we'll get there soon. Listeners, if you have suggestions, feel free to fire off and let us know what you think I should refer to Nick as. Is he a greasy meatball? Is he a rock lobster? Those are already taken on the network, but something along those lines is what I'm looking for. All right, Nick, let's kick things off here. A lot of things to talk about this week. It's kind of hard to start. Pick a place to start, but I think it's easy enough. This is Friday. We are recording this. For those of you who aren't streaming it live, we are recording this on Friday, June 3rd, 3 o'clock, so right after the close of the markets here, 3 o'clock Central Time, of course. we're talking mostly futures stuff, and we're talking futures and volatility and everything. The name of the game today was non-farms. We're coming on the heels here of the big non-farm payrolls report. And I don't know, Nick, you were a Eurodollars guy, so you probably paid a heck of a lot of attention to non-farms back in the day. For me, my old SIBO days, I remember they would come in, they'd have the non-farms, and it would be a big deal, particularly because they would always factor it into what was going on with Greenspan at the time and how that would impact his rates decision. Non-farms lately been kind of a bit of a shrug of the shoulders, not really market movers. This one today seemed like it had a lot more spotlight on it because, of course, Yellen and her crew over there at the Fed have been talking up rates and an increase in the June meeting. So this is the last non-farms before them. Seems like this is going to be the last maybe nail in the coffin, or perhaps the last boost for a potential rate increase. What we saw today was, I don't think you can call it good by any stretch of the imagination. They were expecting somewhere in the 160, 170,000 job increase to the economy there in May. They only got 38,000. According to the Labor Department, that's the worst report they've had since September of 2010. So just not at all positive. And of course, as you might expect, Nick, we look at a lot of different things. Of course, the Fed Watch tool from the CME Group that tracks the Fed funds options and the Fed funds futures, I should say, over there, and kind of what probability they are pricing in. I tend to look at those with a bit of a grain of salt, but they are interesting nonetheless in an aggregate sense. And as you might imagine, once that number came out, they crushed the probability of a hike. At the June meeting, it was somewhere pushing 40% probability, and now it's effectively zero. I think it's less, somewhere south of 5% over there for the June future. I was looking at the July. July is a little bit more optimistic. I think they cut it from about 60% down to about somewhere in the high 30 range. So a better probability in July. I'm not sure why they think the game's going to change in a month, but c'est la vie. Still interesting stuff. So Nick, let's start there. We haven't had a chance to really talk about a non-farms on the show yet. So what are your thoughts on today's number and how it impacted some of the activity you saw out there today?
Yeah, well, I think it's pretty interesting how the trade has been happening given what the Fed speak. So somebody who retweeted a mention that we had about the show at Nick Trades on Twitter. It's Nicola Duke at Nick Trades, and I went and thanked him for retweeting us. But then I saw his new his or her, I'm not really sure. So Twitter, it's generally anonymous when it comes to that kind of stuff. But they had a new background on their Twitter, and it said, "Fed threatens hike, markets tank. Fed delays hike, markets recover." And what's really interesting about that is because that's exactly what's been happening over this last however many months that we've been looking at the Fed doing another hike since the previous hike, and today's no different. I mean, the markets rallied hard on this, and when I say rally hard, people don't think 6 ticks is right, but that's a pretty good size rally in the front month, right? And that's got 10 days left. But when you go out on the curve, right? We talked a little bit last week or on one of the shows how the Eurodollars basically trades 5 years worth of term structure, and if you go out 3 years, the market was up 16 basis points, 16 ticks. That's basis points. So the yield on that 3 year changed by 16 basis points. So it's a pretty good indication that nothing's going to happen next week. I believe it's a week after next, so it's still a couple weeks away. So you see this all the time. You see the Fed will be hawkish. You'll start to see a trickle down in the rates, and then something will come out and the market rallies, meaning the rates go down, right? And then the Fed will hold off. But these numbers are pretty crummy, like you mentioned. Only 38K, and then April and March got revised down for a total like almost 60,000 less jobs. And amazingly, and I have to really check this, but this is what I read, and it's really kind of nuts a little bit. U.S. population's like in the 300 to 320 million range. It says, I read some stuff today, almost 100 million people are not in the labor force. So it's pretty nuts when you look about people that aren't looking for jobs, right? And then you got that on top, but you see that the current unemployment rate is 4.7%. So a lot of people out of the workforce, unemployment rate's low. So, sometimes the public will get a conflicting look at what's happening. Like they see, it's a great 4.7% unemployment. But when you got that many people not looking for jobs, it's a pretty sad state. But anyway, yeah, we had a rally in the Eurodollars. And I wanted to make sure, and I don't think there's anything specific here to point out, because what you're going to find out in the Eurodollars, anybody who's interested, I think it's a good place to start looking to trade, especially as we get into this rate hike cycle or rate watch cycle. We have a hawk, and that means people are looking out for inflation. Then you have what you call doves, and that's people who want to make sure that rates stay low, so we don't slow down. So for a soft landing, so we don't slow down the economy. But when the front month starts moving 6 ticks on this kind of news, that means that there's going to be a range established. So there's stuff going on. There's stuff to do in that first year's worth of contracts. And market and I always try to point out where a lot of the action is in these different expirations. So right now there's a June, July, August, September, October, November, December contract in the 2016 or in the whites for the Eurodollars. It's the first year, also a March of 2017. So you get tremendous amount of volume this week just in, we'll look at the July contract, 620,000 contracts traded, another 135 in June, and then another 100,000 and 150,000 in August and September respectively. So lots of stuff going on there, lots of trade in that small range of strikes. And the really interesting thing, and Mark, is it okay? Can we say something like, can I go out there and say, I'm not a CTA, I used to trade, now I provide technology for people to help them trade, but I believe, and I've talked to my friends when they call me that are brokers and the guys, and there are opportunities in the Eurodollars to trade if you're interested. And some of them are pretty straightforward and require a little margin, I believe. So can I come out there with an idea that might be useful to watch, or can I get in trouble for that?
I think your disclaimer is suitably disclaimed, sir. Go for it. For information purposes only.
And redisclaim. So what I like, Mark, ask me, Nick, what do you like when the Euros rally off this kind of news?
Nick, what do you like when the Euros rally off this kind of news?
Okay, something I always go out there and tell people. I go and look at it. I used to look back when the economy was crud. I would go look in the mid curves, but right now you go and look in the whites, and you look at the strikes. Generally on these rallies, the upside strikes, the strikes above the at the money, okay, they get kind of beat up. They used to get beat up quite a bit from a volatility standpoint. Right now, they're not as beat up as they used to. However, what you see is they have a very low tick price, okay? So you get stuff trading for 1 or 2 ticks. That's $25 or $50 per lot. So that's not a tremendous amount. But what I like doing when you rally into these strikes or toward these strikes, you may not get to that strike, but there might be 1 strike out of the money, maybe 2 strikes out of the money, depending on the expiration. I think it's a great opportunity to buy those 1, 1.25, 1.5 tick calls and then hedge them. Okay, because typically, the market rallies to a point where they think the Fed's going to sit if nothing goes on for that period of time. So you're kind of at a top or a sort of a top of where the futures might go. So I always see there's great opportunity. So 1 tick with an option that's a 15 or 20 delta, if you pay 1 tick, you have to break 5 ticks down to break even on that hedge. So if you do it, right? So you pay 1, you give it a 20 delta. A lot of times it's in the 15 to 20 delta range. When I do that, I like to, when I paper trade in my head or talk to people, I always kind of round up to get the benefit of a mini break. So what you can do there then is you get a 5 tick break, you get your money back. So now you can trade out of that cover, that futures, that hedge, and now you're long those calls for 0. So there's a couple other things you can do. You could wait for the market to chop back up and then put on your hedge again, and then wait for the market to come back down. So basically what you're doing, right, you're scalping your gamma. But I like those cheap calls up here, especially as you rally into them, because they do get cheaper. You buy them, you hedge them, and you wait for the market to break again, which it's going to do. As Nick Trades at Nick Trade says, it's a pretty good cycle. They do something, the market recovers. They say nothing, the market goes back to where it was. So give it a look. It's a real good opportunity. There's the meetings is June 16th and then again in July. So the July contract doesn't cover the next meeting, but the August contract does. And I was looking at those upside calls. I think it's the 99.375 strike. They're trading for like 1 and 1.25 ticks respectively, with like a 15 to 17 or 18 delta. So good opportunity there, I think, from a trade in a low vol, hedge, and scalp. So there's my thoughts on the Euros today.
Former Euro man stepping up. I like that. That's one of the challenges with talking rates is there's so many different products. You could fill a whole show just talking about each of them. You got the Euro, Fed funds, 2-year, 5-year, 10-year, 30-year, et cetera, and so on and so forth. You could really spend a lot of time breaking down all of that. Speaking of which, if you want to follow along with us, we used to say go to cmegroup.com/TWIO, TWIO. That URL, for whatever reason, doesn't work anymore. Probably the easiest way to get it, go to cmegroup.com. Again, go into that little search bar, top right corner. It says search cmegroup.com and just type this weekend or this weekend options, and that should come up with a link to this stuff. It'll say Quick Strikes this weekend options. Click on that, and that'll show you all the report. You can also get it, of course, just search for Quick Strike, QuickStrike online, and you'll get a link to Nick's site there, and you can log in yourself. Probably the easiest place to find it is on the CME site, because they put a lot of cool free stuff out there for you guys to access. You can click along with the different products. Right now, we're talking in the rates complex on the 2-year and the 10-year. Started looking at Fed funds. You think Fed funds would be active on a day like today, Nick? And of course, talked about the futures pricing and the probability. Fed funds options, not really a lot cooking over there, so we can't really dig into that one too much. On the 2-year, though, we saw a lot of, not surprising, I think in both of these products, the vast majority of the action on the front portion of the curve. Again, these are a little bit longer term products. Today's action a little bit shorter term. So we're not surprised to see about 90% of this week's volume over there in the 2-year come in July. Overall open interest increasing by about 13% or so. Same thing with the 10-year, a little bit more even, though, about half of the volume coming in that front portion of the curve in July. The biggest open interest change we saw out there also in July, up nearly a quarter out there from an overall OI perspective. Again, we can talk rates a lot here, but anything else you want to hit on with rates before we hit on some of the other big movers of the week, Nick?
Yeah, just probably one more thing. If you go look at one thing we've been trying to talk about is the weekly options in the treasuries as well, because there is so much opportunity there from a volume standpoint and from a liquidity standpoint. So the 1 week that's expiring today, there was big trade in this week in the 129 puts. So you can look at that a couple of ways. We started the day probably around the 129. We were below 130. We were like between 120.5, 130 in the future. So you can probably look at somebody taking a bet that the numbers were going to be positive from a rate hike standpoint, and that might not have taken place as we've talked about already. But a lot of if you go look at the futures now in the treasuries, you're going to see that we kind of trended. Now we have a little bit of rally. Now we're trending again. So these are more opportunities again to go and look and see and find some strangles or 1x2s that might look like opportunities to sell or to buy one and sell two. So as you get these little pockets where you get a break between the numbers and what's going to happen with the Fed, you're going to see some volatility plays that are also going to be available for you to trade. So if you're new to the rates, it's probably a good time to start looking at the euros, the white portion of that curve, and also the 10-year, that short dated stuff, or even some of the regular contracts from a volatility play standpoint.
All right, let's move on to the other hot thing, lighten it up this week. I don't know, Nick, when we first conceived of this show a while ago, actually, did you ever imagine in a million years, I know I certainly didn't, that soybeans would be such top-of-mind conversation? Did you ever expect this when we first launched this?
I didn't, actually, and as I was making notes for the show today, I put a little thing that said, tell a joke about the show should be called This Week in Soybean Options, right? Because that's all we've TWISO or however we want to call it.
An even worse acronym than what we have already.
Yeah, that's a new acronym because it's been nuts, right? I mean, I couldn't believe the other day or I got to work a little late or whatever, and the market was just up nuts amount of. So I did a little bit more research to that, so I think I have some stuff that we could talk about there. But no, never imagined. We had that pretty good week early on when they had the rain, right? We always go back to the rain in South America that was causing some of the price run up, but I never would have thought it extended this far.
Yeah, I mean, look at the gap up we had this week just in that front portion future, up about from 1086 to about 1134. You're talking 47, 48 handle move out there. Just crazy town, and across the term structure, commensurate moves out there in soybeans. So yeah, we thought after we did the big deep dive last week and dug into them a little more on LSFO here that maybe soybeans would settle down, but not so much, Nick. Still just rocking and rolling out there. Once again, a similar narrative. July kind of leading the charge out there, the most active month yet again. Not a surprise when you have such a big leap in the futures like that. People want to get in. They want to get in near term. They want to get in front month. They want to get a lot of gamma. They want to get a lot of bang for their buck on that move. And so that's what you're going to play near term. You're not going to play 2 years out on something like that. About 140,000 contracts, nearly 40% of the volume coming out there in July this past week. The big mover, the big winner The July 1100s, they are lighting it up this week. Nearly 12,000 of those bad boys lighting it up this week, but pretty active stuff. Also, surprisingly, even though the volume was biggest in July, such an active month already, that it didn't really nudge the open interest that much. The open interest, the biggest change in open interest coming actually out there a little bit farther down the curve in November with about a 5% increase in OI. Again, a little bit smaller volume move has a bigger impact in November, not as big of an open interest out there, but still kind of interesting to see that, Nick, kind of a tale of two different things. The near portion of the curve where a lot of people are rocking and rolling, then a little bit more playing out in November. Also, where the 1100 was kind of the strike du jour. I don't care if it was in July. I don't care if it was in September or even November. That was kind of where the action was. Let's see, about 15,000 of the 1100s lighting it up out here in November. So yeah, just kind of it seems like pick your month, and 1100 was where the action was this week, Nick.
Right, and that's funny you mentioned that specifically because I did a little bit more research this week and was trying to really put or wrap my head around why we could continue the rally, given that all the news was out there, right? The weather sort of stabilized, that type of thing. But and in the past, you and I have talked about how this is sort of more of a fundamental market, right? There are very, very specific things which drive the price, the weather, El Nino, La Nina, the export demand, all that kind of stuff. But it appears that one thing that some of the people are saying out there is that this continued rally, it was much more than it was surprising, first of all, that this continued rally, especially as we, really saw some of the new highs this week. But we're going to, one of the things mentioned was that this was almost like a technical breakout now, right? We've been talking about the fundamentals affecting the price, but 1100 was a real psychological barrier. And when the market broke that 1100, it became a very technical breakout. So we saw a lot more speculative buying just based on the fact that the price got up there. So it was a surprising rally, but then it was surprising from a fundamental standpoint. But when you look at the charts and you look at technically, that's probably what drove a lot of this. And there was, if you go back to what we talked about last Friday, right, there was a kind of a big gap on the close up. And we mentioned how we'd see whether that would be continued after the long weekend, right? Because it was the VWAP, the volume weighted average price, didn't really carry that price so much. It was still sort of low in comparison to where the final closing price was. But then I was watching on Tuesday and Wednesday. So Tuesday we saw sort of a little bit of a pullback, but not much. And we said, we speculated that, well, maybe people are going to come back. They're going to see that price gap, and then they're going to have to cover for themselves. But if you look at it from a long weekend standpoint and saying, hey, Tuesday's not really the day people come back, people really take a really long weekend, that's when we really saw some more activity, and then that sort of that big jump up even more in future. So it could have been I'm curious if it would have been just a regular weekend, whether we would have still seen that big run up, or if it was because people were gone and people got a little panicky while they were sitting on their boat, or while they were fishing, or while they were somewhere else, or at their barbecue and planning on not going to work, that it got a little panicky coming in on Tuesday and Wednesday, and that trade pushed it higher. But there's a few other fundamental reasons, I guess. When there's the export window was expanded, so there was more ability to still purchase the beans, and but we see now, if you saw that run up and you saw that we came back off and we're off for the day, we're still up for the week, but we're off pretty good for the day. I think not knowing much, just from what we've been observing, we might see like it start to trend a little lower here now, especially since we didn't close on the highs.
Yeah, this has kind of been a bit of an education for me. I never was an active soybean slinger prior to launching TWIFO, but so much action out there. It really has caused me to take another look at this product and the setups and the fundamentals and the nuances and how the SKU performs and all the other fun stuff that goes on in a product like this. And again, you guys want to learn that for yourself or check out the latest happenings for yourself. Check out that This Week in Options, this case, the This Week in Soybeans Options report, and you can see all that kind of data for today. I think we got time for a few more here on the old show here. Nick, let's dive really quick into crude once again. Narrative somewhat similar to the others. July kind of leading the charge. We were talking about this in some of our earlier shows this week, including Option Block and others. Kind of a bit of a surprising development out there, or a surprising movement, I should say, out there in crude, where OPEC essentially said, hey, yeah, we're not really going to cut our production, and saw a little bit of a sell-off, and then it seemed like the buyers just stepped in and said, hey, this is a huge buying opportunity. Let's just drive this sucker back up. So it's kind of a little bit of a counterintuitive movement out there. We were kind of joking on that show that maybe, it's going to rally on the lack of production cuts, and then maybe it'll sell off on the next wave of Canadian fires or something. Some oil is becoming purely contrarian. I'm not sure really what's going on out there, but that in spite of all that movement out there, or I should say because of all that movement out there, the front portion of the curve still where the action was. Over half of the volume this week coming in the July portion, about 284,000 contracts, about 53% of the overall volume coming out there in the July timeframe. The 55 calls, the doubles leading the charge out there with about 23,000 contracts over there, Nick. Overall, it was a decent week because, WTI options, again, that's what we're looking at here, listeners. It's a pretty liquid contract, and still all this movement causing about a 4% increase in overall open interest this week. And again, who knows, maybe this kind of push-pull back and forth, will they, won't they, from OPEC and now some of the buyers stepping in. Maybe this will trigger a little bit more volatility to come. Some of our traditional measures of volatility out here in the space, whether you're looking at just a straight up implied from the futures, or pulling that into a VIX methodology like the OIV, which measures, of course, the WTI products, or the OVX, which measures USO. Both of those kind of moving lockstep. Both of those well off their recent highs that were pushing into the 60s not that long ago, now in the high 30s to low 40s range, depending on when you're looking there. So well off at some points. Actually, they got up to 70, I believe, at one point there. So almost 50% reduction in overall implied. Some of that not really surprising given the prolonged and extended rally we've seen out in crude over the last few months. You're going to have vol traditionally come off. The calls have been at a much lower volatility premium level compared to the puts out there in crude. So it's kind of like more of a traditional investment skew shaping up out there. So as you rally up that curve, of course, vol is going to come in. Now we'll see if that all these bulls coming in might be changing the skew up. In fact, Nick, I know you've been watching some of the crude and some of the developments out there in the skew. First off, what caught your eye in the overall broad crude activity? I think you had a few strangles that were catching your eye, and then we'll talk a little bit about what's going on in the skew before we have to wrap up here.
Sure. Yeah, I think I call it a strangle only because I see extreme strikes trade outside the at-the-monies, and they don't necessarily trade as that spread, but it is sort of just a play on the market in terms of what direction people are thinking or where the range might be for that particular product. But, there was some bigger open interest changes in the crude in the front month. It was 33 and a half puts were up about 4,000 or 5,000, and the 70 calls were up about 5,000. And the 70s were an open trade. So there's something happened where somebody put on, right, open interest goes up. That means there's new participants in that strike. So we had an increase up in the 70 calls. So if I look at that as sort of a strangle, and especially when you get sort of like open interest changes, I tend to kind of think of it that way. Also, there was some big trade in the 60 calls. That open interest went down, but there was lots of volume out there as well, I believe. So, again, it's sort of the same thing here. If you read some of the stuff that's going on with the oil commentary and what the OPEC board is saying, and they want the price to go higher, and you're starting to see more people that have had stagnant rigs or sands or machines, the sands machines not running to go get the oil. They're starting to get back in the game again as the prices start to go up here. And I think I read a while ago that like a break-even dollar amount per barrel was like in the U.S. was like $38, and that was a break-even. So they had to be able to sell for $38 in order to make their money on production. But again, in this kind of trade, it looks like you get the OPEC meeting, you get that kind of commentary. They're not going to do anything to quell supply. They're going to let the market dictate it. So I think you're going to see people trying to push that market up. But I don't think, again, just looking at the trends and what's trading and what calls are in demand, the 55 calls sort of telling them that that could be looked at as a barrier, right? So probably look for a range 45 to 55 here, and that's a good trading range for selling volatility or scalping some gamma, that type of thing.
Yeah, it certainly seems like crude is not going to be at a shortage for opportunities for some vol, or perhaps I should say scalping some gamma more likely than some vol. Because I said vol coming off a little bit out there, but we'll see. Near term, maybe, and certainly your strangles are not a bad way to look at what's been cooking out there. Again, kind of puzzling why the lack of a freeze from OPEC would lead to this sort of movement out here in the futures. It kind of selling off again towards the latter portion of the week, but not much here. Overall, it was still surprising movement. You think they would weigh a lot more. I know last week we were talking about a lot of action in crude puts, and it seems like a lot of the interest was still kind of an expectation was crude maybe would retreat back down to around that 40 handle, somewhere around that level post OPEC if they did indeed refuse to cut. And yet, that's not exactly what we saw. So maybe some interesting second wind afoot out here for crude oil. Unfortunately, we don't have any second winds here on the old program, Nick. I wish we did. There it is. There's that music. That means we're coming up against it here, Mr. Nick. But before we go, we talked a lot of fun stuff. Again, listeners, you guys can check it out for yourself. Head on over to cmegroup.com actually just search for This Week In or This Week In Options at the search bar. It's the easiest because the URL otherwise is pretty long. It's /tools./information/quickstrike/This Week In Options, blah, blah, blah. You'll never remember it. Just go to cmegroup.com and then search for Quick Strike or search for This Week In Options. Or you can search for Quick Strike in your Google search. It's QUIK. STRIKE, so don't put in the C. You'll find something else. And Nick, I know you guys said you're working on a pretty cool update coming down the pike. In fact, it should be coming out this weekend, I think. And tell us what else is cooking over there on the whiteboard over there at Quick Strike for future updates to the platform.
Yeah, well, I think we're going to be doing, Twio, Twifo, and I will work on asking the CME to put a shorter link out there, and I did ask if we could change the name to This Week in Futures Options, and I didn't, and I got an okay with that, so we'll see if we can get that going, so those URLs, both URLs will work. But there'll be a new version of This Week in Options getting released on the CME site this weekend, and then we haven't given it to the big application yet, but when it is in the subscription application, you're going to see the ability to click through a lot of links and really dive into the individual cells. So you'll be able to see the most active call or put, but then click on that strike and get details about that strike, see its history, see the listing and the ranking of all of the different strikes within that expiration. So you really get an idea of where the activity is in each of these expirations. And I think that really that's the whole idea of what we're trying to provide to the using public is just finding data quickly, easily, getting a good summary, and be able to investigate really quickly.
All right, Mr. Nick, thank you for that again. You can find that all over there at cmegroup.com, or just find it on the Quick Strike, or just search for Bantix, Bantix, or go to Bantix.com, and you can find the link there. Again, no shortage of ways for you guys can do that. And as you're listening after the fact, you can, of course, check out that tool and see what's going on for the week, and check it out pretty much every day. It's free to use over there at Quick Strike, and if you like some of the cool premium stuff, you can sign up over there as well. And on behalf of Mr. Nick, who is still nicknameless, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course for tuning in live. We do this every Friday, 3 p.m. Central, and let us know if that time works for you, if you like a different time. It kind of just seems to make sense for us because it's the end of the week. We can look back at the entirety of the week's activity in trading, but maybe there's a different time that works better for you guys. Let us know, but it seems like this time is fairly popular. So again, every Friday, 3 p.m. Central via the Mixlr app. If you don't have that, just follow us on social media, and we'll tweet out the link, and you guys can just click on that whenever we go live. Of course, you can also get it on demand wherever your favorite podcasts are available, including iTunes, TuneIn, and Stitcher, and of course, our own website, theoptionsinsider.com. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered. With market data reports ranging from open interest to the term structure of volatility, Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.